Is Regulation T margin suitable for beginners? Have you ever wondered if using Regulation T margin is a good choice for those just starting in trading? Let's break down what Regulation T margin means and how it fits into options trading and risk management. Regulation T margin is a set of rules from the Federal Reserve. It limits how much credit a brokerage can give to investors for buying securities. Under these rules, you can borrow up to 50% of the purchase price of marginable securities. This means if you want to buy $10,000 worth of stock, you need to have $5,000 of your own money. You can then borrow the other $5,000 from your broker. For beginners, there are both benefits and risks to consider. First, using Regulation T margin can increase your buying power. This means you can make larger trades than your cash balance would normally allow. If the stock price goes up, this can lead to bigger profits. However, there are costs to borrowing money. The amount you borrow will accrue interest, which is charged by your broker. This means your investment needs to earn more than the margin interest rate for you to make a profit. Beginners who are not used to managing these costs might find it challenging. Another important point is the maintenance margin. Besides the initial 50% margin, brokers usually requiring a maintenance margin of around 25% equity in your account. If the value of your securities drops and your equity falls below this level, the broker will issue a margin call. This means you must deposit more money or sell some securities to cover the shortfall. For beginners, margin calls can be stressful, especially if they do not have enough liquidity to meet these demands. This could lead to selling at unfavorable prices. Using margin can amplify both profits and losses. If the stock value decreases, it can quickly reduce your equity, potentially leading to losses greater than your initial investment. This risk is particularly significant for those who are new to trading and may not have experience managing leveraged positions or understanding market fluctuations. When it comes to options trading, managing margin becomes even more critical. Options can be volatile, and the margin requirements can vary based on the broker and the specific options being traded. Beginners should be cautious, as the rules around margin can differ and managing risk becomes more complex. In practical terms, Regulation T margin can be suitable for beginners who understand the risks and mechanics involved. Those who are prepared to monitor their positions closely may find it beneficial. However, many beginners may want to start with cash accounts or limit their use of margin until they gain more experience. Generally, margin trading under Regulation T is better suited for those with a moderate to high risk tolerance who understand interest costs and can respond quickly to margin calls. So, is Regulation T margin suitable for beginners? It is not inherently unsuitable, but it does requiring a level of financial knowledge and risk management skills that many new investors may not yet have. Beginners should approach Regulation T margin carefully, educate themselves, and consider their personal risk tolerance before using margin for trading stocks or options.